Hello and welcome. You're watching Indian Interest. I'm Krishnakumar, and today we're talking about the new revised lower GDP growth projections and how it's going to impact you. In a significant move today, the 6-member Monetary Policy Committee of the Reserve Bank of India, led by RBI Governor Shaktikanta, lowered the GDP growth projection for this financial year. The GDP projection now stands at 6.6% compared to an earlier estimate of 7.2%. Remember, the second quarter numbers of the current financial year were out recently, and India's growth numbers were lower than expected. The growth stood at just about 5.5%, 5.4% to be precise, which was a 7-quarter low. Not just that, manufacturing grew at a sluggish 2.2% in the July to September quarter. How will the new revised GDP projection for the current financial year 2025 impact the job market and other things that are important to you? To discuss that, we have Mitali Nikore, founder and chief economist, Nikore Associates, now joining us. Mitali, thank you so much for taking time out to be with us. This is the fact of the matter is that India is still very much a growing economy. 6.6% is still a very good number in the context of the larger global growth projections for other countries. But the fact that we're going to be a good 60 basis points lesser than what we thought is certain to impact the job market.
So absolutely, Krishna. I mean, this is something that a lot of us were projecting after the Q2 GDP numbers came in, that there has to be a correction of the projection that we're doing for the annual growth rate as well. Because at the end of the day, if you think about it, we have not achieved close to that target. And at the end of the day, I mean, this is also an election year. This is a year in which the approvals for a lot of the manufacturing sector schemes have not come through. We haven't seen the services sector job growth take up at that level. So I think, it was expected that this is a cyclical downturn in what we call, in classic economic terms. I mean, this is not a reflection of the strength of the Indian economy or the structure of the Indian economy. It is a cyclical kind of downturn. However, at the end of the day, we have to think about ways to get out of this cycle.
Right. The fact of the matter is that, it's not just the GDP number. Look at the number surrounding it. Look at the manufacturing growth number, just 2.2% for the last quarter. Are these, signs of a larger slowdown in the Indian economy?
So, Krishna, I think we have to think about this sector-wise. I mean, when we look at the manufacturing sector, that's the one sector that's gone from 14% growth in 22-23 to 2.2% in 24-25. Now, here, what is going on? What is going on is a little bit related to the PLI scheme, right? Where we see that, a lot of proposals came in when the scheme was launched, and now to some extent, there's been a slowdown. Definitely, with the government putting in a little bit more effort and with some effort from organizations like Invest India, again those proposals are expected to pick up next year. So this is very cyclical in the manufacturing sector. And if we look at the other sectors like agriculture and services, we've actually seen recovery in those sectors coming in, even in Q2, because actually the performance of agriculture in Q2 24-25 was better than Q2 23-24. And similarly for a few other services sectors. So I believe that, this is not a structural impact. This is a completely cyclical kind of impact caused by somewhere the elections and, a little bit of inertia that comes in because of the elections.
Right. As we talk about these numbers, there's also talk of a squeeze in urban spending. Urban Indians are spending less, and that consumption hit is starting to impact the GDP, isn't it?
Exactly, Krishna. And I think that's a very important point that we have to address. It's almost like an elephant in the room when we are talking about income inequality. See, one thing is GDP growth. GDP growth and income inequality in many emerging economies across the world has gone hand in hand. And even when we look at some of the richest economies in the world, I mean, let's look at the US, for example, we know that there is considerable amount of income inequality even in the US, where there's a cost of living crisis on one hand, and on the other hand, you have the tech billionaires, which are rising. And that is, we have to ask ourselves, is that the kind of economy that India wants to be? Because We are seeing that even playing out in our country. You have so many unicorns, that are coming up on a daily basis. So many startups doing so well, and yet at the same time, you do have a cost of living crisis come up in the lower income segments. So somewhere we have to design progressive tax policies. We have to design income redistribution policies to ensure that our growth is deep. It's not only happening for the top income segments, but it is going down to the middle classes and the lower income communities who can also benefit from this national growth.
Right. The urban spending squeeze is one problem, but the other issue is the economy not performing is faltering. In that sense, in the first half of the year. And there are some hopes that the numbers could become better, because we're talking about a slowdown or so-called slowdown in the GDP growth in the July to September quarter, after which comes the festival season. Do you think a recovery in the GDP growth rates is possible in the second half of this financial year?
So I think, Krishna, we have to take that with a little bit of pinch of salt. And the reason for that is that if we look at the reasons why GDP growth has actually reduced in this period, one of the major reasons is a slowdown in investment, private capital investment. It's not as much of a slowdown in consumption. Consumption has continued on a very, clear growth trajectory, which has even come in Q2 2024. We've seen actually consumption increase by nearly 6%. So, I don't think that it's actually a matter of consumption. Of course, when consumption increases in the festive season, that will benefit GDP growth. But our major problem lies in manufacturing and investment, private sector investment. We have to get private sector investors in. We have to get the FDI, which has, recently left, in record numbers. People have withdrawn from, FIIs have withdrawn from the Indian markets. We have to get that back. And that is only possible when we work with, the manufacturing company, invest, come and invest in India and be here for the long haul, be here to export from India, not only to manufacture in India.
There is talk of a possible stagflation in growth, and many economists denying the fact that there is no stagflation in that sense. There is inflation going up above the dangerous 6% mark, and then you have GDP coming down at the same time below the 6% mark, and this is very difficult even for the Reserve Bank of India to reconcile with, because on one end it is the environment is right for a rate cut to boost growth, but on the other hand, how do you manage inflation? Mitali?
I have a very different. Yeah, hi Krishna, can you hear me?
Yes, please go ahead.
Yeah.
Right, we'll just get back in touch with Mitali, who is helping us understand how the GDP growth at this stage, there is a revision downwards, and how it will impact the fact that this lower GDP growth has been fueled by multiple factors, and has resulted in the Reserve Bank of India lowering the GDP growth projection for the current financial year 2025 to 6.6%. Now, on your screens are the quarterly GDP breakdown you have for the last quarter of 2023 Q4. If you compare it, it's 6.18, and for Q1 of FY24, it's 8.24. It is a multi-quarter low of 5.4% that had come out 5.36%. So there it is. It pales in comparison to the kind of low compared to the high GDP growth percentages that have been put up in the recent quarters. The lowest in recent times being 6.18%, and with now, first it was Goldman Sachs, which lowered India's yearly GDP prediction to 6.3%, and now the Reserve Bank of India has revised its GDP growth numbers for the current financial year to 6.6%. This was a follow-up to the 7-quarter low GDP number of 5.4%. And side by side, you see inflation in the recent months from, say, April to October inch up from 4.83 now, up to 6.21%. In fact, there was a reprieve in the months of July and August when the inflation number was below the 4% mark, comfortably in the 3.5% territory, but since then has been climbing steadily up. It's a difficult balancing act for Reserve Bank of India at this stage. Before we let you go, the simple question at this stage that I have to ask you is this: with the lowering of the GDP number to 6.6%, talk to us in terms of the people watching this broadcast. How do you think it's going to impact them? Tell them, break it down for them. What does it mean for them?
Absolutely, Krishna. And I think I just want to also respond to your question about the inflation. I'm sorry, the network was a little patchy at that point. At the end of the day, I've been studying the inflation numbers, and currently the headline inflation is very much in, the range of 4 to 6%. So that's very much within the RBI, band, which is set at 3 to 6%. So at this point in time, for the RBI to say that, oh, the inflation is simply too high, actually, that's not fully the reason why they are not going ahead with the rate cuts. It's mainly because of the food inflation. So, the headline inflation actually not doing so badly, but the food inflation is the one where, we see those headwinds coming in for, a very high and increasing inflation rate. So when we think about, a decelerating kind of growth, the picture that you were painting, that maybe growth is slowing down, inflation is going up, that is not happening at a very fast pace. I mean, we are still seeing a very good and healthy growth rate in GDP, one of the fastest in the world. We are still seeing some amount of job creation. We are still seeing that, the RBI is coming out and proactively managing, the inflationary headwinds, especially food inflation. So I think, from all of these points, we can see that the RBI as well as the, central government are really looking at mechanisms for, unlocking new growth pathways. But yes, in the short term, as this cyclical impact takes place, it will be harder to create jobs. It will create, some amount of inelasticity in the job market, that is, looking at ways of creating new jobs, maybe that will not be so fast. So I really think that, the employment impact, and also for entrepreneurs and small businesses, this is a time when there will be a little bit of a slow, amount of activity in the market, and there'll be a slowdown in, new orders that are coming in. So this is something that, an everyday citizen could actually experience, the slowdown in such a way. Maybe the pace will not be as fast, but we are still growing. So there will still be jobs, and there will still be, work coming in for entrepreneurs, but maybe it will not be as fast and, quick as it used to be.
Okay. We will leave it at that. Mitali Nikore, founder and chief economist of Nikore Associates, there helping us understand what a new revised lower GDP estimate means. Thank you, Mitali, for taking time out to be with us on this edition of In Your Interest.